Hi everyone, and this video lecture covers Objective 5 in Chapter 2. So we are going to learn how to prepare the financial statements for service, merchandising, and manufacturing companies. So first, let's take a look at service company income statement. So service company, as we know, typically does not have inventory accounts. Okay, so like in this case, we're looking at a consulting company. So this consulting company generates revenues by providing services. So in this case, we can see that the income statement starts with the revenues, then less operating expenses that include salary expense, rent, depreciation, marketing, and so on. And the difference between the revenues and operating expenses gives you operating income, which is 30,000. So now let's look at merchandising companies. So in this case, we have one merchandising company, and we have sales revenues, and which is 150,000. Then selling the products is pretty much the main business of this company. So therefore, there are certain cost of goods sold. Then you look at sales revenues less cost of goods sold to generate gross profit, which is 43,500. Then you also have operating expenses. So finally, you come to the operating income. If you compare the merchandising company income statement with the service company income statement, it's not that very different. Okay, so the only difference clearly here is the cost of goods sold and gross profit, and you don't have these items. If you go back to the previous slide, the service company income statement. So next, we can take a look at how to find the CGS for a merchandising company. So typically, you always have the records of inventory at the beginning, in the beginning of the and also the end of the fiscal year. So like in this case, you have a beginning inventory balance, which is 9,500. Then definitely you are going to make a purchase. You buy more products for sales. Okay, you have a purchase cost, you have freighting, and you have import duties if it's a national trade. Then you add them. The result is cost of goods available for sale. So basically, you put them on the market. You sell to the end clients and the customers. Then by the end of the fiscal year, you can do the fiscal count to find out how many products. Okay, how many product units left in your warehouse, and you call that any inventory. Then you subtract any inventory from the cost of goods available for sale. Then the result is called a cost of goods sold, the CGS. So in this case, the CGS is 106,500. So that's how you find a CGS for a merchandising company. So for manufacturing company, it's much actually complicated. Okay, so we start with the sales revenues, and minus CGS, you get a gross profit, and then minus operating expenses, you get operating income. It looks pretty simple here in terms of calculations. However, the way to find a CGS is much harder than merchandising company. Okay, merchandising company. So there are 3 inventory accounts are involved. The first one is a finished goods inventory. The second one is a work in process inventory. That's happening in the factory. And the raw materials inventory. So all these 3 inventory accounts actually are part of the calculations. So we can take a look at what's happening here. So first of all, you have a raw materials inventory. So you are going to put some raw materials in your manufacturing, in your production. Then these materials will be delivered to the factory, and the cost of the raw materials will flow into work in process inventory in the factory. So you can have a direct materials cost, you have direct labor cost, and also you have a manufacturing overhead. So you put all these 3 ingredients in your factory, and you finish your manufacturing process. You have some finished products, and the finished products will be delivered to the finished goods inventory, and they do carry value, and the value they carry is called cost of goods manufactured. Then when the sales happen, that's how you recognize the cost of these goods sold. So there's a CGS, and the CGS will be put in your income statement to show you the gross profit and eventually the net income and so on. So you can see that all three inventory accounts actually are involved in the calculation of the CGS and eventually will impact your income statement. And if you look at all these accounts involved, we have a direct material cost, we have direct labor, and also we have so many accounts in the manufacturing overhead part. So we're going to talk all of them in the next few slides and also examples. So first, let's take a look at how to calculate the cost of direct materials. So this is very important because you have to find out the cost of direct materials used in the manufacturing to figure out, so in total, how much is the cost in the manufacturing and production, so that eventually you're able to derive the cost of goods manufactured, okay, finished goods manufactured. Okay, so that's sort of idea here. So let's first take a look at raw materials inventory. Okay, so focus on that. Then let's find out during the current production period, how much is the cost of the direct materials used. So the idea is actually very simple. Once again, it's basically, first of all, you look at your beginning raw materials inventory balance, then you purchase some raw materials according to your production plan, and maybe you have freighting and also tariff, whatever. So you add all these together, we have so-called materials available for use for manufacturing. But it doesn't mean that you have to use all of them. Maybe you will use a part of them, then you have some leftover, you have ending raw materials inventory existing in your warehouse, okay, in your storage room, whatever. So the difference between the materials available for use and your ending balance of raw materials inventory tells you, okay, that's basically the cost of direct materials used. Okay, so that's the idea of steps how you can find direct materials used, okay, in your manufacturing. Okay, so let's take a look at this very interesting example here. So you are a new accounting intern at Thomas Bikes, and your boss give you the following information and ask you to compute the cost of direct materials used. Assume that the company's raw materials inventory contains only direct materials. Okay, so import duties, and you have beginning raw materials inventory, and you have ending raw materials inventory. You also have freighting and freight out. Then you have the purchases of direct materials. So this question is asking you only the cost of direct materials used. So let's focus on that. I'm going to use Excel worksheet to show you the mathematical steps how to find the solution. Okay, how to find the solution. Alright, so this is an Excel worksheet that I'm going to use in this work. Okay, in this work. So first of all, I'm going to take a look at, okay, so according to the formula in the previous slide, so what is beginning raw materials inventory balance? Okay, I do have that number, which is 4,100. Okay, and also I need to take a look at the new purchase. Okay, the new purchase. So the purchase cost, according to the question we have here, we have a 16,400. So I'm going to put 16,400. Then I wonder, do I have any imported duties? Yes, I do. So I'm going to put imported duties here, which is 1,300. And also I wonder, do I have any freighting? Don't put a freight out, because freight out is not part of your cost of getting your raw materials ready for manufacturing. Okay, so that's not really something you want to include. Only freighting. Okay, so we're going to put a freighting. Okay. Okay. For the freighting, we have basically 200. So now, if I add them together, I have a total raw materials for use. Okay, so the calculation is pretty simple. Or you can just use Excel sum function to add all these numbers. Okay, so in this case, we can see that we have in total. Sorry, I think there is some issues here. Let me take a look at it. Should be B24 instead. So the total direct material, total raw materials for use, is actually 22,000. Okay, 22,000. So now I'm going to say, well, I need to find actually how exactly how much is the cost of direct materials used, not really available for use, okay, because I may not use all of them. So therefore I'm going to actually minus, okay, the ending, sorry, I have a typo here, it should be beginning, okay, beginning, and the less ending, okay, RM, raw materials, okay, inventory balance. So I'm looking at, go back to the question, I'm looking at 1,900. So I'm going to put the 1,900 down here. So the difference, okay, the difference tells me that, okay, raw materials actually are used. Okay, so I'm going to do the subtraction, 22,000 minus 1,900. So the answer is, okay, the cost of raw materials used is $20,100 US. Okay, so that's the example. So you can take a look at actually this slide, and that's the summary of the Excel worksheet work. Okay, Excel worksheet work. So feel free to also take a look at this slide, and if you have any questions. Okay. So now once we figure out the direct materials used, we are going to move to the factory, okay, in which the manufacturing process is happening. So we have a beginning working process inventory. So basically you have some unfinished products, unfinished whatever things that left in the from the previous fiscal year. And during the current manufacturing period, I'm going to add additional direct materials, and I'm going to pay workers to work on unfinished products, as well as the new production plan. Okay, the products in the new production plan. And also I may have to deal with the utilities, machine maintenance, machine depreciation. So I'm looking at the manufacturing overhead cost. So together we have a total manufacturing cost to account for during the current production plan. So you have some unfinished materials, unfinished products, plus your new production plan. Okay, and a lot of the direct materials just added, and also a lot of workers are ready, and also some manufacturing overhead and so on. So together you have a total manufacturing cost to account for. Then by the end of the manufacturing period, you can take a look at say a month, or maybe a quarter, or maybe a week, whatever period. So after that you take a look at how many unfinished products left. So you can kind of estimate, okay, what is ending working process inventory. So the difference tells you the cost of goods manufactured and transferred to the warehouse of finished goods. So that's sort of idea how you can use a working process inventory to find a CGM, because you have to find a CGM to find your CGS eventually. So you started with the direct materials inventory to find direct materials used. Then you add that ingredient into your factory to find the cost of goods manufactured. Then you are going to use cost of goods manufactured to find your CGS eventually. So we're going to take a look at that piece later. But I just want to tell you that this is how you find a CGM, which is very important calculation. So once you have CGM, then you are going to look at the third inventory account, your finished goods inventory account. So we have covered direct materials inventory in the beginning. Then secondly, we have covered the working process inventory. So finally, we are looking at finished goods inventory in order to find the CGS. So the CGS calculation is a very important part. It's a very important part in accounting. So you have a beginning finished goods inventory. So some of the products you have not sold yet, so they are still in a warehouse. Now you have cost of goods manufactured, which is carried actually in all these finished, freshly, newly finished products. So these products, they are finished and delivered to your warehouse to join unsold finished products. Okay, to join unsold finished products. So together you have the cost of goods available for sale. So you have a lot of products available for sale and they carry cost. Then by the end of the sales period, you can take a look at, okay, so how many finished goods that are left in my warehouse. So that's called ending finished goods inventory. So the difference will tell you basically how many products are sold. So the cost carried by the sold products is cost of goods sold, called CGS. So now I just walked you through the raw materials inventory to work in process inventory and finally finished goods inventory. And we have talked about all three inventory accounts and also many other many other accounts involved in this long process calculation. So now I'm going to show you a very comprehensive example, okay, that covers all the calculations involved in CGS. Okay, so let's take a look at this question here. We are going to compute the CGS and the CGM for the Blue Sea Company for the most recent year using the amounts described next. Assume that raw materials inventory contains only direct materials. So this question, we have three inventory accounts: raw materials inventory, right, and work in process, and finished goods inventory. Then we have some other additional accounts like purchase of direct materials, labor, indirect labor, insurance on plant, depreciation, repairs, maintenance, marketing expenses, and the general and administrative expenses. So I'm going to tell you that what these accounts for, because some of the accounts are related to manufacturing overhead. Some of the accounts are related to operating administrative expenses, which have nothing to do with manufacturing. So we're going to talk about all these accounts in the next few slides. I'm going to actually still use an Excel worksheet to show you the calculation, and later you can reconcile the calculations in the slides, in the next few slides, with my Excel worksheet to have a better understanding of this calculation process. Okay, so I'm going to take a look at this Excel worksheet. So first of all, I have to take a look at, can we find the CGM? Okay, how can we find the CGM? So the CGM is mainly the manufacturing part. So I have to start with the direct materials inventory. Okay, then later I need to take a look at the work in process inventory. Okay, then finally I have to look at finished goods inventory. Okay, I have to walk through all these inventories in order to find out the cost of goods manufactured. Okay, so these are three very important inventories I have to look at. Okay, then finally CGS. So let's take a look at the direct materials inventory. I have to figure out during the current manufacturing period, okay, so what is the cost of direct materials used in my production, in my manufacturing, okay, So I'm going to take a look at direct materials inventory to find direct materials used in the current manufacturing period. Okay, so that's my first step. Okay, so I start with the direct materials, okay, beginning inventory. Okay, so that actually is given if you take a look at this question information. The raw materials inventory beginning of the year is 27,000. So I'm going to start with the 27,000. Then I'm going to look at the purchase, okay, purchase of direct materials. So you may have to buy some new raw materials in order to complete your unfinished goods, unfinished products from the last fiscal period, okay, plus some products in the new production plan. Okay, so the purchase of direct materials, what I have here is 79,000. So I'm going to put the 79,000 here. Okay, Now next I'm going to look at, do I have any tariff here? I don't see any. Do I have the freighting? Okay, I don't see any. So I don't see any additional costs that I have to consider. Okay, have to consider in the this inventory calculation. So what I'm going to do is I'm going to say, okay, that's it. That's all I have. So I'm going to find out direct materials available for use. Okay, so it's going to be basically the result of adding the DM beginning inventory to the purchase of direct materials. So together I get 106,000. Then I'm going to look at the direct materials ending inventory. Okay, so that I'm able to find direct materials used. So the any inventory is given also. That's a 31,000. So I'm going to put 31,000 here. Then the next step is I'm going to look at the subtraction. Okay, I'm going to use a DM available for use. Okay, not for us, for use. Okay, sorry, I think I have to go back here and put the E here. Okay, so now I'm going to use a direct material available for use minus the any inventory. So the result is the cost of the direct materials used in the manufacturing. Okay, so which is 75,000, So now I'm going to go to the WIP inventory to find out. Okay, so what are the total manufacturing cost account for, finishing, manufacturing, finishing the products, and how could I get the cost of goods manufactured? So this is the second inventory account I need to focus on. So now we are a step closer to find the CGM. Okay. So I'm going to go back to this question information page here. So we have a work in process inventory, and beginning, ending, and also we have raw materials used from the previous step, and also we have direct labor. Then we have some other additional costs: insurance costs, indirect labor costs, depreciation expenses, and the maintenance expenses, and so on. So all these costs or expenses actually are part of a manufacturing overhead cost. You see the marketing expenses and also general and administrative expenses, right? So these two kinds of expenses actually are not part of your manufacturing overhead costs. They are not your direct costs or indirect costs in the manufacturing. Okay, so we don't have to really include them in the calculations. Okay, so they are more like distracting, items. So put a trap here. Maybe they will, you will use some of them and you get a wrong answer. So we don't actually need marketing expenses and the general and administrative expenses in the calculations. So I'm going to start with the WIP beginning inventory balance. Okay, so what I have is what I have here is 43,000. Okay, so next I'm going to look at the direct materials used. Okay, direct materials used, and that's available because we have just found this value, which is 75,000. So I will put the 75,000 here, and okay. So next I have the direct labor cost. Okay, that's also given, which is 83,000. So I'm going to put the 83,000 right there. Okay. Then next I need to find the manufacturing overhead. So to find the manufacturing overhead, I have to actually take a look at all these accounts. Okay, so there are quite many of them. I have to be careful with that because there are many. So I need to consider direct labor cost, okay, which is 46,000, and also I need to consider insurance on plant. If it's insurance on headquarters, you don't have to include that, but it's insurance on factory, on plant, so I need to add 8,000. Then depreciation expenses for plant building and equipment, not for the headquarters, not for the marketing department building. is for plant, factory building and equipment. So I have to also add that expense. Then plant maintenance repairs, that's definitely part of your manufacturing. So I add 4,100. So now I can add, finish the calculation. So the manufacturing overhead cost involved in this production is 70,800. So now I'm going to look at what is total manufacturing cost account for. So I'm going to add all these numbers, okay, from beginning inventory to DM used, DL costs, and also manufacturing overhead. So together I have 271,800 total manufacturing costs to account for. So next I need to go back to the information page. So we have to actually find out what is ending inventory balance for WIP, because if you have that any inventory balance for work in process, you can do the subtraction to find out, okay, so for the finished products, for finished and the transfer products, so how much is the cost they carry? Okay, so then I'm going to look at WIP ending, okay, inventory. In this case, we have 28,000. So the difference tells you actually the cost of goods manufactured and transferred. Okay. So now we have finished the first one, the CGM. Okay, so just one step, I'm going to give you the answer. Okay, So I'm going to use 271,800 minus 28,000. So the difference tells you CGM, which is 243,800. Okay, so that's a CGM. So next one is the CGS. How to find the CGS? Okay, how to find CGS? In order to find the CGS, we have to use the last inventory account called finished goods inventory. Okay, finished goods inventory. Okay. So this is how you find the CGS. Okay, you have to use a finished goods inventory to find the CGS. And how to do that? Well, we have to take a look at the beginning inventory. Okay, so I'm going to put the FG. I use FG for the finished goods. Okay, so FG beginning inventory balance. Okay, that's in the question as well. And you look at this line, finished goods inventory. Then we start with 16,000. And you have the CGM, which you have calculated in prior steps, which is 243,800. Then you have FG any inventory. Okay. And the difference is CGS, cost of goods sold. Okay. So you start with the beginning inventory, then you have some newly manufactured products and transferred, right? And transferred into this warehouse, and then you look at, by the end of the fiscal year, how many goods left, how many products left in your warehouse. Okay, and the difference tells you, okay, how much you have sold. Okay, so the ending inventory balance for finished goods is 29,000. So I'm going to put 29,000 there. So now what I can do is I can add 16,000 to this 243,800, then minus the 29,000. So the result is 230,800. So this is actually cost of goods sold. Okay, cost of goods sold. Okay. Actually, I should add one more line. Okay, and I think it might be better. So let me insert one line here, because I need to actually find out the total. Okay, cost of the total cost of goods for sale. Okay, so this is actually when you add 16,000 to the 243,800, so which is 259,800. Then this CGS can also be calculated using the this total cost of goods for sale minus, okay, this finished goods and inventory, okay, which is the same number. So CGS is actually 230,800. Okay, so that's how I find the CGM and the CGS. So I'm going to put them in red to highlight to make sure you see that, okay, these are the solutions. Okay, these are the solutions. So now we have finished this exercise. We have the CGM, which is 243,800, and we have CGS, which is 230,800. Okay, so that's about this exercise. So now you can review the following slides and to check our work. So we can see that we have found the CGM, which is 243,800. That's exactly the answer we have. And also, if you take a look at the CGS, we have 230,800. That's also the answer we have. So we have just finished this exercise. Finally, when it comes to the income statement for manufacturing company, and the format is very similar to the merchandising company. So you have sales revenues minus the CGS, which has been determined in a very complex process. Then the result is gross profit. The gross profit subtracts operating expenses, and it gives you operating income. So that's the income statement for the manufacturing company. Okay. So next, I would like to talk about product and period cost. Okay, before we compare these industries. So what is product and what is the period cost? Okay, so that's a very important question. So if you look at all costs across the value chain, which I have shown you in prior slides. Let me go back to the prior slides and copy paste that picture if I have it. Okay, I think this is the one I have. So let me actually bring that picture down to this slide. Okay, to this slide. Okay, so to give me some space here, I'm going to put it down here. So actually, this is a value chain we have here, right? So we have talked about this value chain so many times, and that's what we have here. That's what we have here. So what is product cost? The product cost actually is happening only in this segment, the production of purchases. So we're looking at the inventoriable product cost. For the service companies, we don't have product cost. In the merchandising companies, we have purchases, right? So we have a cost of merchandise itself through the purchases. You may have freighting, you may have import duties and customs, okay, if you have international trade, okay. And for the manufacturing companies, we're looking at direct materials, direct labor, and manufacturing overhead. So together, we're looking at production cost, or maybe the manufacturing cost. So the product cost actually are essentially the manufacturing cost, okay, in this context. And the next is accounting treatment. So you actually kind of capitalize, you kind of inventorialize all these costs. Okay, you don't really recognize these costs, the value as expenses, until you can sell them. When you sell them, you are going to expense the inventory. You're going to expense the capitalized products as CGS. So that's kind of idea here. So now, what is period cost for the service companies? So all the rest of five components in this value chain actually are period costs. Okay, all the remaining 5 components in this value chain figure are period cost. So it's true for the service companies, it's true for the merchandising companies, it's also true for the manufacturing companies. And you are going to expense all of them right away during the current period, and we call them operating expenses. So once again, operating expenses consist of all the remaining 5 R&D, design, marketing, distribution, customer service expenses. So all these 5 segments, actually give you the operating expenses, also the period cost, So I hope this slide explains to you very well about how to distinguish product cost from period cost, and also give you the comparison of service, merchandising, and manufacturing companies. And when we come to the accounting treatment, you should know that in the merchandising manufacturing companies, in the beginning we try to kind of capitalize all these costs, okay, expenses, and we are going to expense the inventory. We're going to expense these costs when all these products can be sold. Okay, can be sold. Okay, so that's about the product and period cost. Okay, so next, and this is balance sheet differences. Okay, so let's compare all three. Compare all these three different types of companies. So we talk about the income statement. The income statement difference is very little. It's very little. The calculations are quite different across all these different types of companies. But when we come to the format, the difference is very little. Okay, the difference is very little. Okay, so the if you review the prior slides, the service companies normally don't have CGS, and the merchandising companies and the manufacturing companies do have CGS. And the way to find a CGS is different. For the merchandising companies, it's very simple, but for the manufacturing companies, it's much harder. Okay, so that's about income statement. So the second kind of a financial statements here is balance sheet. So the balance sheet records all these assets, liabilities, and shareholder equity accounts, right? We know that. So if you look at inventory accounts we involved here for the service company, we don't have any inventory accounts typically, but you have found exceptions. I'm not going to go there. For you may argue with me, hey, restaurants have inventory accounts. Yes, I agree. Okay, but typically service companies don't have inventory accounts. So for example, CPA firms, or maybe consulting companies, or maybe banks. So for the merchandiser, there is only one inventory account called the merchandise inventory. For the manufacturing company, a typical manufacturing company has all three inventory accounts, namely raw materials, work in process, and finished goods inventory. So this is about Objective 5, and I hope you like it. And I will talk about other objectives in the next video lecture. Thank you very much.